All right, good morning, everyone. It is 8:29 on the morning of January 30th, 2023, and this is my pre-market strategy session. And the title of today's video is Red Monday, Green Week. And now, it's been a while since I've seen a pattern like this, and the pattern actually hasn't set up yet. Here, let's take a look at the weekly chart here real quick. And what I mean by Red Monday, Green Week is, for some reason, there seems to be a bit of a phenomenon where when things are bullish and the stock market is doing something called climbing the wall of worry, there seems to be a phenomenon where it sells off in the first half of the week, like Monday and Tuesday. It starts out red, and then from the rest of the week, it finds a way to climb back up again. Now, we've got some reports coming out this week. I think there's some Fed minutes. There's a meeting on Wednesday, I think, and I'm not sure what the forecast is for the Fed announcement, but I think that the days of 75-point hikes are going to be in our past, and going forward, rate hikes will be somewhere around 50 to 25 basis points. And if that's the case, the Fed is getting close to the end of its tightening cycle, which means it's less hawkish, which is more bullish. There's not exactly the case for a bull market yet, but a less hawkish Fed, a Fed that is getting closer to the end of its hiking cycle, it's a positive for the market. The market will, say, hey, okay, this is where rates are now, and life goes on. That's the way it's going to work. So right now, what I have on the chart is a Fibonacci from, let me go back to the daily here real quick. And I feel like I'm about to sneeze. So if I mute real fast and fade away on you for just a moment, it might be because I'm sneezing. I have a Fibonacci here that is at November the 22nd of 2021. That's the top of this recent bull market. And I went all the way down to the very bottom to an open that occurred on, it's the 13th, Friday the 13th. Oh no, Thursday the 13th, October 2022, just a few short months ago. And basically, I've just kind of traced out where this Fibonacci is right now. And I use 25% levels instead of whatever the Fibonacci is in that 20% range. And I've forgotten at this point what it even is. I've replaced it with 25%, and I've forgotten what that Fibonacci is. So right now, in the pre-market, 292.87 is the 25% retracement level. It's not a Fibonacci retracement. It's just 25%. And so we are just in the pre-market dipping down below that 25% retracement level. And you can see here this roughly, I'm going to just call it 293, roughly 293, has been a zone of support and resistance, or you can even kind of call it consolidation a little bit too. Just this 293-ish plus or minus, was that about 10 points or so over the past almost year now. Actually, let's call it 8 months, so 2/3 of a year. There's been a lot of support and resistance in this zone, and so here we are. In my personal opinion, I think that just given a relatively small amount of time, we will see prices dip down a bit here. I mean, it could be, my thinking is just a couple days, but it actually could be a couple weeks, and then we continue to the upside after that. So yeah, this week, and I've forgotten what exactly comes out this week, but it doesn't actually really matter. I mean, that much. I mean, you know, the market's going to do what's going to do anyway. Regardless, kind of what all these numbers are coming out. Slowing inflation is definitely going to be good for the market. That we'll definitely see a reaction from that. But it ought to wear off. Whatever those numbers are ought to wear off after, the effects of whatever those numbers are ought to wear off relatively quickly. So, within, I don't know, 2, 3, 4 trading days after the next PCI report comes out, the market's going to continue doing whatever it's decided to start doing anyway. And in my opinion, that's bullish. And so here we are. Let me put that Fibonacci back up again. A retest here. We bumped up against this from the underside 3 times, and the 3 strikes you're out thing really seems to work. 1, 2, 3, and the market couldn't break back up above this 25% level. So I said, okay, well, let's sell off a little bit. Now here we are again. We broke up above it and we closed up above it. Could be a false breakout. It could. In my opinion, I think that we might spend, I don't know. I mean, in my opinion, it's just going to be a couple of days here at this 25% level until we start creeping back up to the 38.2 level, which is a really great level to go and test. That's my opinion. That's my bias. I get to realize whether I'm trading in congruence with my bias or contrarian to my bias. It's very important for me to recognize my bias and then trade accordingly, and I get to know whether I'm right or wrong, whether being contrarian or congruent is right or wrong, and I get to very quickly trade in the other direction if I'm wrong. I get to also let my winners run and let those wins extend when I'm correct. So here we are. My personal opinion is we spend a couple of days, we'll come back and, I don't know, maybe test the top of this resistance line, and then after a couple of days, we'll start heading back up toward this 313.26. This could be a pretty slow grind. We could be looking at something quite similar to what we saw here develop over here. Generally speaking, although this does look like sideways action, this was upward movement, and that this small area right here was positive movement until it came back down again. And so, in my opinion, I think this is what we're about to see is a lot of really choppy action right in here for the next move up. But the up days ought to be more aggressive this go round than in this example right back here. So today we're at a pullback. We're beneath this 292.87. We're beneath that level before the open, prior to the open, and we'll get just my personal opinion. This is just another pullback. And actually, you know what? While I'm at it, let me show you this too. Check this out. So back here on let's see, the 6th of January. We had a run up of about almost 9%, 8.69% in this 8 days, 1, 2, 3, 4, 5, 6, 7 days of trading, and then we had a pullback, and then again, here we are in another 7 or 8 days. Let's see, 1, 2, 3, 4, 5, 6, 7 trading days. We are at. Let me make sure I get that correct. From top to bottom there, 8.9%. So, we've had 8%, or we'll call it 9%. 9% up, a pullback, 9% up. Let's see a couple of days of pullback here, and then see another thrust to the upside. Gain some support after a couple of days, and we get some bulls in here to BTFD, buy the dip. All right. Yeah, that's the way I'm seeing things. I'm still bullish. Uh, and then also, here we go. Just to kind of do a little bit more of a little bit of a deeper dive here. We came down. This is the 38.2 right here, Fibonacci level. This yellow line right here, kind of in the middle of the screen there. And the market opened up below it one time, tested it a second time, and then came back and tested it a third time. And 3 strikes you're out. The market said, okay, well, we can't go down. Let's go up. And so that's where we are. I think it's an eventuality. This 311.18 is probably a good spot for a test coming up here relatively soon. Actually, let's see if that's close to 9%. Let's see if a move to that level is close to 9% here. Let's see if we go from, suppose for a moment we go from right here. Let's see what this is. Yeah, right in that, 8% or so, 8.5%. Yeah, so that'll work. Yeah, let's get a pullback here. Let's get a couple, we had a pullback here. Let's get a pullback here, and then let's get a next move up after that pullback. Obviously, the markets are down 1% in the pre-market. I think that today is probably going to be a good day to sit on my hands, if I get a superb setup where everything lines up on the 1 minute and 10 minute, which is actually the Qs are oversold right now in the pre-market, but oversold conditions, we are still in a bear market. This is still a bear market. So oversold conditions in the pre-market isn't as bullish as it would be in a bear market. So if we were over here in this part of this bull market over here, and we came into oversold conditions in the pre-market, it's a lot easier to enter into a trade on those lows during a bull market than it is, to try and enter into a trade at the open during a bear market, because it obviously the trend is your friend until the end, and so until this trend is broken, which looks to me like a break above 334 will get us clearly out of a downtrend, at least for the short term, and you can be pretty bullish at that point. Although I do believe that we are setting up for the next leg down, which would be somewhere between now 4 months to 10 months away, because historically speaking, here is the inverted yield curve. This is the 10-2 inversion. This is the inversion that all the big players on the market are paying attention to. Once this yield curve comes out of inversion, once it starts to normalize again, that's when we see the next big down move in the equity markets. And so this inversion can last anywhere between 12 months and 18 months. And right now, I think we're just closing out the 7th month of this inversion. Let's see, 1, 2, 3, 4, 5, 6, 7. Yeah. So we're about to go into month 8 of this inversion. And historically, if history is any guide, which the old saying is, what past performance is not an indication of future returns. Well, these are rather reliable patterns. When the yield curve inverts, there's a recession coming, and when it normalizes again, we figure out what is causing all of this recessionary sort of activity or prognostication, and then everything gets sorted out again. All the financial mayhem that occurs, gets straightened out, and the Fed does what it has to do, and so on. And then we normalize again, and then it's back to bull after the big downturn. It's back to bullish behavior again. It's just the way the market works. It's just the way it goes over and over and over again. For as long as the American markets have been around, but even for as long as past European, Japanese, and Chinese markets, for that matter, that go back thousands of years. It's just the way it goes over and over again. So, yeah, personally, my thought is that we come, out of this into some kind of a bull run that's lasts 10 months or whatever, doesn't quite make it back to the highs, and we see the next leg down. Now, the next leg down, will it take us lower than this recent sort of low that we've put in here? Probably. Not absolutely sure, but probably. And that's somewhere between, again, 4 months and 10 months away. Taking a look around at things, so the VIX was doing a really nice job of breaking down into new lows here. 19.12 is the low that we saw here really quite recently. And so now it's kind of playing a tag game here. I think if we see a couple of up days and then a nice new plunge down below 19.2 again, we ought to be below that for a few months. And we should see bullish behavior. The dollar is giving up a lot of ground. This is good. A weak dollar, down in the 70 range or so. Let me put a monthly on this. A weak dollar down in this range right here, that's not good. When the dollar goes super weak. And so, sort of like the habitable zone that the Earth is in around the sun, it's not too hot, it's not too warm. So these peaks you can see here in the dollar, too hot, definitely. This is probably, that's 85. Okay. All right. And so then let's see, here's 2001, dollar strength. Everybody starts going to the dollar for safety. Again here, 2008, 2006, so people started going to the dollar, not too bad. Somewhere in this area in here, was that roughly around 95 or so? That's a good spot for the dollar to be. If we start breaking back down into that area again, then the emerging markets will like it. It's as good for the U.S. economy having emerging markets happy is good for our import-export situation, so on and so on and so on. Yeah, things are looking okay for the short term, and I mean for somewhere between 4 and 10 months. I think things are going to be okay. There is something on the horizon, no doubt about it. There is definitely something on the horizon. This inversion, it's going to play out. We're going to see a next big downturn. But in the meantime, while this curve is inverted, things can be bullish. If you go back and you look at the markets between, let's see, where the 10-2 inverted back here in January of 2000, let's call it February of 2000, and leading up to about a month or two before the normalization. So from January to November of 2000, the equity markets, the tech stocks were booming. Same thing back here, the housing market, which is, this is the dot-com bubble, and this is the housing bubble. When it first inverted back here Wednesday, let's see, that's February of 2006, all the way up until a couple of months before, here March of 2007. The S&P, everything, the Qs, tech, everything was booming. And it's not until this thing starts to normalize again where we see the real big crash. So here we are again, 7 months into an inversion. I think history will prove that this bear market that we're experiencing right now will see a rise and then another big fall after the yield curve inverts. But things will be bullish until that yield curve starts to normalize again. There's no reason to not think so, really. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. I will see you at tomorrow morning's strategy session. I hope you had a good weekend. Thanks for tuning in. I am out.